If you don't have a good handle on the movement of interest rates, then it's very hard to know what the value of a bond is. It affects the credit markets and it affects equities as well. Today's Tuesday, July 5th, and we start the second half of the trading year looking at the MOVE index. Now, the MOVE index is often called the bond VIX, and it measures the implied volatility of options on Treasury bonds. So, what this is essentially telling you is that there is a lot of uncertainty in the Treasuries market. And this ties essentially back to the fact that there's a lot of uncertainty related to the path of interest rates. And this has implications for assets across the globe. If you don't have a good handle on the movement of interest rates, then it's very hard to know what the value of a bond is. It affects the credit markets and it affects equities as well. So if we bring up the S&P 500 against this index, you will see that when this bond volatility measurement started to pick up in late 2021, that is when the equity market really started to decline, as you can see here. Now, we talked last week in this video here about the implications of a big options equity expiration at the middle to end of June and how that could buoy the equity market. But now the window is now past us, and we opined that, look, the support for equity markets now is lower. So we think there can be lower lows in the S&P 500. And the fact that this MOVE index is now not just at 2022 highs, but at highs going back to March of 2020 tells us that the bond market is also pricing in more volatility ahead, and that is an equity headwind, right? That is not something that you want to see if you are bullish on the equity space. Now, our subscriber note this morning, we laid out this map, and if you're interested in getting access to these subscriber notes, hit subscribe now. As you can see on the screen, you get a free 7-day trial. At the bottom of this note, we put up this chart here, which lays out the important dates going forward. We want to draw everyone's attention to July 15th, which is a pretty good options expiration. Then there's a big VIX expiration on July 20th. Then we have the FOMC on the 27th. Not only that, we have earnings kicking off mid-July into the end of the month. So there's a lot packed in the end of the month. We think people are likely to hold equity hedges now, which again are struck at lower levels. And if you look at bond volatility surging here, that is again an equity headwind. Now, in general, if you're just trying to figure out when can I start to allocate money back into the market, we think that the number one indicator of more stable equity prices going forward is going to be a reversal in this MOVE index, because that tells you that implied volatility in the treasury market is coming down. That means that traders have a better handle on the future path of movement of interest rates, and that will allow people to better price various equities, credit market, etc. So if you have any questions on this, please put them in the comment section below or hit us up at SpotGamma on Twitter. And again, please head over to spotgamma.com, hit the subscribe now button. You'll get a free 7-day trial of our service, and you'll get these daily notes packed with a lot of different information every single morning.